everyone, this is Brandon Garrett with Snow Garrett Wealth Management with a special market update in the midst of recent volatility. Stocks are on track for their worst one-month performance in over 9 years, as a combination of higher bond yields, U.S.-China tensions, nervousness over the upcoming midterm elections, 6 straight months of gains, and worries about peak margins this earnings season all added up to a big sell-off. We know big drops can cause uneasiness and concern, so we wanted to share our perspective on the recent weakness and put the sell-off into context with 10 points to consider. First, the S&P 500 index had one of its least volatile third quarters in history. In fact, it was the first year since 1963 that the index's usually volatile third quarter didn't have a single 1% change up or down. The S&P 500 had gone 74 consecutive days without a 1% move, the 10th longest streak in history. The bottom line is, equity markets were wound tight and some type of volatility was likely. Second, October has historically had above average volatility, yet average returns. October is known for spectacular crashes, such as 1929, 87, and 2008. But in reality, it's about average in terms of returns. What it really should be known for is volatility. Incredibly, no month has seen more 1% changes up or down than the month of October for the S&P 500 going back to 1950. Next, the economy is in excellent shape. Consumer spending is growing solidly, consumer and business confidence is high, the job market is quite strong, manufacturing surveys are near record levels, and by historical standards, interest rates are still fairly low. Stocks tend to do very well after midterm elections. The average 12-month gain off midterm election year lows is over 30%. And since 1946, the S&P 500 has never been down 12 months following midterm elections. That means we may have just entered the best 9-month period for stocks in the entire 4-year presidential cycle. Pullbacks are normal. Even though stocks tend to average a 7 to 8% gain each year, they also tend to have 3 to 4 pullbacks each year, meaning 5 to 10% drops, and at least one 10 to 20% correction. We got both earlier this year, but history tells us we may get more. Still, we see the potential for a year-end rally. Corporate profits remain quite strong. Consensus expects a 21% increase in S&P 500 earnings per share in the third quarter, supported by strong U.S. economic growth and tax cuts. Over the past month, forward earnings estimates for the S&P 500 have risen by about 1%. The tariff impact has been minimal to date, and repatriation has given companies a huge cash hoard that they may invest in growth or return to shareholders. Weakness ahead of elections has become normal recently. In fact, ahead of the November 2016 presidential election, the S&P 500 fell 9 consecutive days, one of the longest losing streaks ever. With the highly anticipated midterm elections coming up in November, some form of jitters isn't surprising. Over time, stocks tend to do well as interest rates rise, as long as rates are rising because of better economic growth. We believe that is the case now. When rates spike, as they have done in recent days, and as they did during the taper tantrum in 2013, volatility usually spikes as well. However, we think much of the increase in interest rates is now behind us, which could enable stocks to settle down in fairly short order. All of our favorite leading indicators point to continued economic growth, including the leading economic index. As our recession watch dashboard indicates, we see only early signs of excesses that have ended past economic cycles, such as excess leverage, overspending, or extreme overconfidence. Even the yield curve is steep in some in recent weeks, a positive signal. We have a market-savvy Federal Reserve chair who won't take a yield curve inversion lightly. And lastly, despite tough rhetoric from both sides, we see a U.S.-China trade deal as very likely. Though a deal may not happen until after the midterms, the two parties have too much to lose economically, and especially in the case of the U.S., politically. Regardless, the amount of fiscal stimulus put into place in the U.S. this year is 3 to 4 times the dollar amount of the tariffs that have been implemented or threatened. That's it for our special market update. If you have any questions about what we discussed or would like to schedule an appointment to review your personal financial situation, please give us a call at 817-550-6750.